Hey, welcome back again. Hope you had a nice break, and I think now we can still continue. You remember in there, just before the break, we ended on the average loss, and then we said average loss, it is applicable on the under insurance. If any property is underinsured, then comes into place average loss. Only when the property is underinsured. So then we look into another terminology that is used in business studies, which is also of importance to you to understand, because when you understand the terminologies that are used, then you will be able now to break down the question and understand exactly what is required of the question, especially when you've got all these small weights or terms that are applicable in the insurance. Then we've got excess also. When you look into excess, we are saying every insurance company would require that a person who is insured must pay a certain portion of money before the person can claim. That is called an excess, an amount that is payable by you as an insured person to the insurance company before the insurance company can pay the claim out. That portion that comes from you, it is referred to as the excess. That is the amount of excess. So excess amount will differ from insurance to insurance. Other insurance may not use excess. Some other insurance don't have excess. Others do have excess. So it's important that you understand that there is also an excess that is applicable when you claim at the end of the day. This could be an example if it happens that you claim when your car was involved in a particular accident, and then the insurance company pay a certain portion, and then an amount that is left, it's 5,000. The 5,000, it is now paid by you. The portion is the portion that you must pay. This portion is called an excess. This is the excess portion, the portion that was paid out of their own pocket. The insurance company paid the market value, which is 155. Maybe the insurance company would decide to pay 150,000. The 5,000 is paid by you as an excess. This is basically a practical example that we can use for excess purposes. Then we move to the other weight, that is subrogation. Subrogation simply means that now the insurance company have the right to stand on your behalf if it happens that you are involved in an accident, and the third party must always pay if the third party was on the wrong side. The insurance company can pay for you as the insured person, but the insurance company can go on your behalf and claim from the third party. The third party would be the person whom you were involved in an accident with. That is the third party. And the insurance company will go and claim on your behalf after paying you. Then that is called subrogation. The rights that the insurance company have to stand on your behalf and claim from the guilty, claim the money back from the guilty party. Then that is called the subrogation. Then we've got reinsurance. Reinsurance simply means that if the risk is too much to bear, if the risk is too much to bear, or the risk cannot really be possible for a particular company to carry alone, the company decides to reinsure the particular insured person. If it amounts to certain million, it means the damage will be too much in case of the risk. So the company decides that it will lose when it is supposed to pay a certain portion. So it does what we call a reinsurance. You are insured with this company. The company itself decides to reinsure with another company that deals with reinsurance. There will be different companies dealing with reinsurance. When you are reinsured, it's when the company whom you are insured with, the company decides to insure you with another company. The most important element in this regard will be to reduce the risk, to lessen the risk. The amount of risk is too much in order for the company to be able now to carry that amount. So that is why the company decides now to go and reinsure that particular company. This is a practical example of a 4.5 million. And then if it's too much to take with one company, that very same company will decide now to engage another company dealing with reinsurance and insure this risk. What is insured is basically the risk. So the company will decide to reinsure the risk itself. Now, we've got two principles applicable to the insurance. These principles of insurance are indemnification as the first principle of insurance, and then we also have got the principle of security. Now, the two principles are applicable in any insurance. Now, in terms of the indemnification, it simply means any risk that is insured, it's a risk that may or may not happen. But in case of security, this principle is applicable to the risk that we will definitely be sure that the risk will definitely happen, even if it's not today, but at a certain given period of time, that is going to happen. Let's look further into the full details of these. Now, importance of insurance in this regard would be, for the business, you insure against theft. You cover your business against fire. You can also cover for product liability insurance any defects that will happen to the product, then you can cover the risk of that nature also. It helps the business in that in that nature also. Also, employer's liability insurance. If an employer is injured on duty, then the insurance company will be able to cover on behalf of the business. The insurance company can cover employer's liability insurance because an employer will be liable for a person who gets injured on duty. The insurer is always liable for that. So the insurer will always have now to ensure that there will be a payment or a compensation that is done for that particular person. So businesses use these employer's liability insurance for a case where a person can be injured while the person is on duty. We will still entertain that one in our presentation today. Buy and sell insurance for co-owners is part of the importance of the insurance for the businesses. Then we can further look into the if there is a certain amount of money that is insured. So it simply means that now the value of the businesses, it's a lot when we look into a 3 million business. That value is too much. So it means we can insure that amount of money also in a buy and sell insurance for co-owners. We can still have those cover, and this one will help businesses also in case one partner is no more there, a business is covered, and then the business will still sustain. Now, let's look into the importance in terms of the individuals. Individuals also, theft and burglary happen to many people in our lives, and that is basically what can still be covered, and it is important for individuals. Individuals also own motor vehicles, and when they are involved in a particular accident, insurance will also assist. That is basically the necessity of an insurance for the individual people. Then a person goes on retirement. When the person goes on retirement, a person still needs some money going on retirement so that the person will be able now to sustain while the person is no more working. Retirement is more important for individuals also. Death in the event of death. Individuals cover themselves so that if one individual dies, and then there could be something that is left on the table also. In case of death, then if there is also unpaid debts, then when one dies, the insurance company can still be able to pay for that. It also loses due to unemployment. If there is unemployment, we've got UIF, unemployment benefit insurance also. That will also assist in case of unemployment. That is a practical example of individuals who are paying a particular portion of money during the course of the time when the person is still working, so that when the person is no more working, then the person will be able now to be covered, and the person will get something whilst the person is still looking for another job.